So let's talk about some of the tax proposals that have been floated by the Biden camp, and I think interestingly, we were sort of fixated on the capital gains tax, and so we did a little research here and want to share it with the viewers because there's a lot of people sitting on some very large gains.
Yeah, so we talked about how a blue sweep would potentially be good for the market in terms of stimulus, but we also think the tax implications of a blue sweep could accelerate a rotation within the market and change the opportunity set. So basically what we're looking at here, the blue line is the maximum tax rate on long-term capital gains through history. This data goes to 2014. It's provided by the Treasury Office. And the shaded area is the actual realized capital gains as a percentage of GDP in that year. And basically what we're seeing, so the Biden proposal in terms of capital gains taxes is increasing the maximum marginal long-term capital gains rate to 39.6% for those that have gains or income above $1 million. And what academic research suggests is when you raise the long-term capital gains rate or having a high long-term capital gains rate that's only realized upon selling the asset, which is the situation we could very well be in, what it does is it creates a lock-in effect. And the lock-in effect means if I'm sitting on a highly appreciated stock, I am just going to do whatever I can to maintain that position, not sell it because I do not want to pay those taxes on the gain. And so, and a lot of times investors do this throughout history, even to their detriment. Even if there are better opportunities for that cash and it makes sense to pay the taxes and move into a different investment opportunity, they won't do it. So it could create a very strong lock-in effect. So if that tax situation
post-tax.
Exactly. This is a great distinction. So if there is a blue sweep and that is on the table and it looks like it's going to get passed, in our view, what would likely happen from a game theory perspective, and it's backed up based on prior changes in tax laws, is people would view the current capital gains rate as a discount. And I want to hurry up, and anything I have in my portfolio that I don't like because it's highly appreciated, if I'm going to sell it, I need to sell it now and move into things that I do like. And so what you get is a one-time spike in realized capital gains. But then once we're in that higher tax regime, nobody wants to sell. Now you're locked in. I re-engineered my portfolio all I needed to. I realized a lot of gains, but now I'm not selling anything because the capital gains rate is so high. It's just it wouldn't be worth it. So the best analog that you've highlighted there on the screen, Will, was in 1986. So that was actually during the Reagan presidency, the Tax Reform Act of 1986. I mean, that Tax Reform Act in its entirety did a lot to lower taxes, close loopholes, reduce the number of brackets on income, et cetera. But it also increased the long-term capital gains rate. And you'll see, if we can go back to the chart real quick, you'll see a huge spike in realized gains as a percentage of GDP prior to that change. That was folks front running it, saying, okay, capital gains rate for this brief period of time, capital gains are on sale. I'm going to go ahead and realize gains. And then you'll see how much capital gains as a percentage of GDP dropped after that. So it's really just a one-time cash grab is all it is from a taxpayer perspective.
Right. And then post-tax, people who are holding on and are reluctant to sell, that's very supportive of the equity market, because when you have fewer sellers, like we have today, it's supportive.
Yeah, and as we sort of bring this full circle, what that means from our perspective, and we've highlighted this in prior videos, is we talk about how much value stocks have underperformed, how historically cheap they are relative to these growth stocks that have done so well. And if this were to go through, that could be the catalyst. If you're going to sell something that has huge gains, it's not going to be value stocks. It's going to be your growth stocks, and you're likely going to rotate into cheaper assets. So there could be that one-time sell of those highly appreciated assets that could catalyze this rotation that looks way overdue, for
Yeah.
sure. And then if we could pull up that chart one more time, there are two other big spikes in realized gains, but you'll notice they happen prior to recessions,
Right.
and they happen during big changes in leadership in the market. So the one was at the peak of the tech bubble. You had a lot of people cashing out of their highly appreciated tech stocks, and then we went into recession. And during a recession, if you're short on your income, what you can do is sell some of your assets to sort of supplement your income and get you through a recession. So that really changed the leadership in the market, went from tech to more cyclical and financials and more value type areas. And then the same thing happened in 07, where you had a big spike in capital gains, not because of a change in the capital gains rate, but because we going through a recession, people needed to sell some of their investment assets to supplement their income. And you saw another big change in leadership away from value and financials more into growth. So there are definitely a lot of precedents where this change could catalyze a pretty big rotation in the market.